It used to be that when a corporate executive talked about sustainability,
Yeah.
it was a lot like someone buying an incredibly expensive high-end gym membership just so they could tell everyone at dinner parties that they go to the gym.
Right, right.
You know what I mean? It was a line item in the budget strictly for public relations. You print out some glossy brochures with pictures of someone planting a tree or
Holding a tiny plant in some dirt.
holding dirt.
Yeah.
You write a nice check to a local charity and you call it a day.
Yeah.
But behind the scenes, you aren't actually putting on the running shoes and doing the grueling workouts.
Right.
It was universally viewed as a pure cost center.
Yeah.
Just a distraction from the actual serious goal of a business, which was making money.
Well, and that was the defining mindset of the corporate world for decades, honestly.
Yeah.
Sustainability was relegated to a siloed department down the hall, completely divorced from the chief financial officer and the core business strategy.
Just totally separate.
Oh, yeah. Executive leadership treated environmental responsibility as a philosophical choice, or at best, a really burdensome compliance task just to keep regulators off their backs.
Right. Just checking a box.
Exactly. It was assumed that any dollar spent on being green was a dollar stolen directly from shareholder returns.
Well, I was just digging through Niroshan Pathiraja's book. It's called The Green Catalyst, the manager's playbook for turning green finance into business results.
Mm-hmm.
And it completely dismantles this old gym membership myth.
It really does.
According to this playbook, treating sustainability as a PR exercise isn't just outdated. It is a massive strategic liability today.
A huge one.
We are at a point where separating your profitability from your sustainability means you are fundamentally mispricing the future of your company.
Yeah.
Okay, let's unpack this, because to make a claim that bold, something foundational about how money moves around the world must have changed.
Well, it has. We are witnessing a rewiring of global capital dynamics that really, it rivals the scale of the Industrial Revolution.
Wow, really?
Yeah, I mean, the conversation has completely outgrown corporate social responsibility. The central thesis we are looking at here is that the most effective, most ruthless route to operational excellence and competitive advantage is now environmental stewardship.
Okay.
And the mechanism driving this massive pivot isn't morality or a sudden corporate awakening to climate science.
Right. It's not just everyone deciding to be nice.
No, it is the global finance sector looking for ways to protect its money.
So extending that gym analogy, it's less about buying the membership to look good and more about the realization that if you don't actually do the heavy lifting to get in shape,
Right.
your business is literally not going to survive the marathon that the market is forcing you to run.
That's a great way to put it.
You have to leverage this shift in capital to fundamentally rebuild your corporate anatomy so you can live longer and perform better.
And the book frames this perfectly for pragmatic, hard-nosed leaders. It steps entirely away from theoretical climate debates, and it treats sustainability as the ultimate strategic asset. It gives managers a framework for using modern financial instruments to build businesses that are more resilient, much more efficient, and ultimately vastly more profitable.
Oh, okay. I love the theory, but if I'm a manager or a CEO listening to this, my natural instinct is a little bit of skepticism.
Of course.
It sounds a bit like wishful thinking, right? That doing the right thing also magically makes you the most profitable.
Yeah.
So let's look at a real-world proof of concept. I know the book highlights Ørsted as the ultimate metamorphosis, and their story is wild because they didn't start out as a green company at all.
They were the furthest thing from it.
Yeah.
So Ørsted is currently known as a global energy powerhouse and the absolute world leader in offshore wind energy development.
Okay.
But historically, they were a state-owned Danish company called DUN Energy.
Wait, Danish oil and natural gas, right?
Yes, Danish oil and natural gas. They were a traditional, incredibly carbon-heavy utility company running on coal. They were sitting on a mountain of legacy fossil fuel infrastructure that was rapidly becoming a massive financial liability in a decarbonizing European economy.
So how do you turn a massive oil and gas ship around without completely bankrupting the company? I mean, the sheer capital required to abandon coal plants and build offshore wind farms from scratch.
Yeah.
That must be astronomical.
It is. You fund it by tapping into a completely new pool of money using what are called green bonds.
Green bonds.
Yeah. So Ørsted realized that their long-term survival required them to weave decarbonization into their core commercial strategy. So they issued green bonds to finance the transition.
Wait, okay, let's just pause right there and look under the hood for a second, because the mechanics of this are crucial.
Sure.
A standard corporate bond is just an IOU, right?
Exactly.
The company asks investors for, say, $100 million and promises to pay it back over 10 years with interest. What makes a green bond any different?
The structure is very similar, but with a green bond, the capital raised is strictly ring-fenced. Right? So the company legally commits to using those specific funds exclusively for environmentally beneficial projects, like building a wind farm.
Oh, I see.
In return, investors who have strict mandates to hold green assets in their portfolios eagerly buy up these bonds.
Okay.
So for Ørsted, this provided the massive influx of capital needed to transition their entire operational model. They abandoned the dying coal model, built the wind infrastructure, and achieved unassailable market dominance.
And financial researchers have actually dug into the data on these kinds of transitions, right, to see if it's a replicable strategy. The evidence points out that, yes, overhauling your entire operation to comply with new environmental standards, it incurs heavy short-term costs.
Right. This is not cheap up front.
Right. But the mechanism of how this pays off is fascinating. Those upfront expenses are dwarfed by the long-term advantages. I know there's a study from Horvatova in 2012 that looked exactly at this.
Yes, the Horvatova study is key here.
I know.
Because the advantages become highly quantifiable over time. First, you see vastly enhanced brand equity, which opens doors to new markets.
Right.
Second, you achieve optimized operational efficiencies. Because when you consume less energy and create less waste, your baseline operating costs drop significantly.
That makes sense.
And third, you severely diminish your regulatory risks.
Oh, yeah.
You are no longer terrified of a new carbon tax passing the legislature because you've already engineered carbon out of your business model.
So green finance is the bridge. It gives companies the cash required to survive that painful short-term transition so they can make it to that highly profitable, low-risk future.
Exactly.
But why is there suddenly so much money available for these green bonds? I mean, why are investors just throwing cash at companies to reinvent themselves?
Right.
There has to be some macro pressure driving the people with the checkbooks.
Oh, absolutely. The emergence of this capital is being driven by what the book identifies as the regulatory reckoning.
The regulatory reckoning.
Yeah, we are moving from an era of voluntary feel-good public relations straight into the era of legally enforceable frameworks.
Right, so the era of you can do this if you want is basically over. It is now mandatory.
It's entirely mandatory.
Yeah.
The European Union is really spearheading this with something called the EU taxonomy.
EU taxonomy, okay.
Think of it as the ultimate hyper-specific dictionary for the modern economy.
Dictionary.
Yeah, because for years, companies could vaguely claim a project was eco-friendly
Right.
just to attract investors. The EU taxonomy eliminates that ambiguity entirely.
Wow.
It is a strict rulebook that dictates exactly down to the scientific metric what constitutes an environmentally sustainable economic activity.
Oh, so it prevents a company from just putting like a single solar panel on the roof of a coal plant and calling the whole operation green.
Exactly. You can't do that anymore.
Yeah.
And this dictionary is actively reshaping how the biggest companies on Earth operate. Volkswagen's a really great example of this. They completely aligned their entire green bond framework with the specific standards set by the EU taxonomy for manufacturing low-carbon transport technologies.
And Volkswagen didn't undertake that massive compliance effort just to secure a positive news cycle, right?
No, definitely not.
They did it as a matter of financial survival.
Yes.
Because by aligning with the taxonomy, they ensured that institutional investors who are required by law to prove their investments are truly green
Right.
could continue to buy Volkswagen debt. It was a defensive move to maintain access to global capital markets.
That's exactly it. It was about keeping the money flowing.
And it goes even further than the taxonomy.
Oh, yeah.
We also have the Corporate Sustainability Reporting Directive, or CSRD,
Right. The CSRD is massive.
which essentially forces companies to treat their carbon emissions with the exact same rigor as their cash flow.
Yes.
Your energy use, the waste you generate, the carbon footprint of your logistics network. These are no longer just rough estimates buried in a PR brochure.
No, they are audited public metrics assessed right alongside your profit and loss statements.
Wow.
And that level of transparency directly fuels the second macro force, which is the capital markets revolution. We are seeing trillions of dollars shift into ESG-aligned portfolios, environmental, social, and governance.
Right.
Institutional investors like massive pension funds are looking at climate change and realizing It isn't an abstract ecological problem. It is a direct systemic risk to the long-term value of their portfolios.
Because a factory in a flood zone or a product line heavily reliant on cheap fossil fuels is a financial liability now.
Exactly.
Mhm.
Because these massive investors want to mitigate that risk, they are demanding green financial instruments.
Hmm.
They are actively seeking out companies that are future-proofing their operations.
Okay.
And because of this tidal wave of institutional demand, we see a phenomenon emerge called the greenium.
The greenium. I love this. This is one of the most powerful concepts in the book.
It really is.
Let me try an analogy to break down how this works for a second.
Please do.
Okay, imagine you walk into a bank to get a commercial loan to build a massive new office complex.
All right.
Normally, the bank assesses your risk and gives you an interest rate of, say, 7%. But you sit down with the loan officer and explain that this new building is going to be 100% solar powered. It's going to utilize recycled steel and achieve net zero carbon emissions. The bank looks at their own internal mandates to fund sustainable projects.
Right.
They look at the lower risk profile of your building and they say, well, because this aligns perfectly with our ESG goals, we are giving you the VIP discount.
Yep.
Your interest rate is now 5%. That discount, the reality of securing cheaper capital simply because your project is green, is the greenium.
That captures the mechanics perfectly. The greenium exists because there is an oversubscribed demand for ESG-aligned investments.
Mm-hmm.
The book provides a staggering real-world example with Masdar, a clean energy company based in Abu Dhabi.
Oh, right.
When Masdar issued their inaugural green bond to fund solar and wind initiatives, the market response was overwhelming. The bond was oversubscribed by 5.6 times.
Wow, so for every single dollar they were asking to borrow, the market was offering them nearly $6.
Yeah, exactly.
That's crazy.
And when you have that much intense competition among investors to fund your project, the fundamental laws of supply and demand take over.
Right.
Masdar was able to drastically lower the interest rate they offered on that debt. They secured vastly cheaper, highly abundant capital.
And researchers have quantified this across the broader corporate landscape, too.
Oh, yeah.
The market has moved far beyond theoretical premiums. There is a study from Cronin, Rochelle, and Thum in 2021 showing that ESG factors are now measurable in basis points on corporate debt.
Right. And for anyone unfamiliar with the jargon, a basis point is just a fraction of a percentage point.
Right. But when you are borrowing hundreds of millions of dollars,
Right.
knocking 50 basis points off, your interest rate translates to millions of dollars in pure cash savings every single year.
It creates a completely bifurcated market. If you embrace this trend, you get the greenium discount.
Mm-hmm.
If you ignore it, you face the brownium penalty.
Brownie.
Yet your capital costs will surge. You will simply have to pay significantly more money just to keep your lights on compared to your competitors who have decarbonized.
Okay, well, that paints a very clear picture for a multinational conglomerate raising billions in the bond market.
Sure.
But we have to look at the micro realities.
Right.
Because here's where it gets really interesting. Not every listener tuning in is running a global utility company.
Yeah.
What does this massive shift in capital mean for a mid-sized business?
Yeah.
What about the suppliers, the logistics companies, the businesses sitting right in the middle of a complex supply chain?
The pressure on those mid-sized companies is arguably even more intense.
Really?
Yeah. And it brings us to the third driving force, which is the customer transformation.
Okay.
Specifically, the dynamic of the B2B net zero ripple.
The B2B ripple.
Right, because we often focus on everyday consumers choosing a sustainable brand at the grocery store.
Right.
But the truly tectonic shifts are happening in business-to-business contracts.
It's the ripple effect of the mega brands making massive public pledges.
Exactly.
Because companies like Apple, Amazon, Unilever, they've all committed to achieving net zero emissions.
Mm-hmm.
But here's the catch. They aren't just promising to clean up their own corporate headquarters.
No.
They're committing to net zero across their entire value chain, which are known as Scope 3 emissions, right?
Yes. Scope 3 is the game changer.
Yeah.
It means Apple is legally and publicly responsible for the carbon emitted by the third-party company that manufactures the glass screen for the iPhone.
Wow.
They are responsible for the emissions of the mining company extracting the silicon and the logistics company driving the finished boxes to the retail store.
Which means if I run a mid-sized manufacturing plant that supplies screws or glass to Apple,
Yeah,
Apple's corporate carbon problem is suddenly my urgent problem.
right in your desk.
If my factory runs on a dirty power grid and is highly inefficient, my emissions ruin Apple's net zero pledge.
And Apple will not hesitate to cut you out of their supply chain to protect their own compliance status
They'll just drop you.
in a heartbeat. Major corporations are now requiring their suppliers to measure, independently audit, and actively reduce their emissions.
Wow.
If you cannot provide that data and show a downward trajectory, you will quite literally lose your contracts.
Right.
Strong environmental performance is no longer a nice-to-have feature to win a bid. It is the baseline prerequisite just to get a seat at the B2B table.
The Playbook uses Coca-Cola HBC as a case study for this.
Oh, yeah, that's a great one.
And it illustrates the strategic reality perfectly. So Coca-Cola HBC is investing immense amounts of capital into bringing the production of recycled PET plastic in-house. And they are rolling out massive reusable glass bottle initiatives.
Right.
Now, it's very easy for a consumer to look at a recycled Coke bottle and assume it's a nice philanthropic effort to keep plastic out of the ocean.
Right, you think, oh, they're saving the turtles.
Exactly.
But the corporate reality is highly calculated and deeply commercial. Coca-Cola HBC is undertaking these incredibly expensive operational overhauls because they have to.
They have to.
They are facing new regulatory requirements on packaging, but more urgently, they have to secure their long-term contracts with major global retailers.
Okay.
Retailers like Walmart or Tesco have their own aggressive Scope 3 net zero targets.
So if Coca-Cola HBC didn't aggressively decarbonize their packaging, a massive retailer could look at their supply chain and say, well, stocking your soda puts us in violation of our own public carbon pledges.
Exactly.
We have to take you off the shelf.
Right. They'd say, sorry, we can't sell Coke anymore. So they are spending millions on recycled plastic to protect billions in future revenue.
Wow. It all routes back to the bottom line and basic operational survival.
It really does.
So we have the macro pressure of regulations and the greenium making capital cheaper, and the micro pressure of B2B contracts enforcing net zero down the supply chain.
Right.
This brings us to the actual machinery of the business itself. Let's look at the operational imperative. Does accessing green finance and focusing on sustainability actually make a company better at what it produces?
Yes, because it acts as a forcing function for operational upgrades that fundamentally slash baseline costs.
Okay.
When a business accesses green finance, they use that capital to invest in highly energy-efficient machinery. Or they optimize their global logistics to minimize fuel consumption.
Right.
Or they install AI-driven smart controls in their facilities. Every single one of those initiatives reduces waste, which directly widens their profit margins. But the most compelling operational advantage is how this framework drives pure innovation.
Yeah.
By every metric, green R&D is simply better R&D.
I want to break down why that is because it sounds almost counterintuitive.
Sure.
You would think adding environmental restrictions to a product design would limit what an engineer can do.
Right. You think that it ties their hands?
Yeah, but the book uses Ericsson as an example, and they utilize a green financing framework to allocate capital specifically for the research and development of their 5G and 6G technologies.
Yeah, and Ericsson places a very specific constraint on that capital. The new 5G technology had to be at least 35% more energy efficient than the previous generation.
Wow. And when you hand an engineering team a strict constraint like that, telling them they have to achieve faster data speeds while using significantly less power, you force them to rethink the entire architecture of the product.
Right. They can't just do business as usual.
You can't just rely on brute force. They have to innovate.
Exactly.
They end up designing a system that operates with far less friction and waste. So that sustainability constraint didn't just meet an environmental goal. It resulted in a technically superior product that strengthened their competitive positioning in the global market.
And extensive market studies reinforce this dynamic across industries.
Okay.
When analysts look at firm value, there's a study by Lee, Min, and Yuk from 2015 that found high CO2 emissions actively destroy a company's valuation.
Actively destroy it.
Yes. And another one by Matsumura, Prakash, and Vera Munoz in 2014 confirms that proactively managing carbon emissions significantly enhances firm performance. Because the market is increasingly sophisticated. Investors look at high emissions and see a massive unrecorded liability. They see a company that is going to be battered by future carbon taxes, or one that is operating highly inefficient legacy machinery.
Right. Conversely, companies that implement proactive strategies like the green R&D at Ericsson,
Yeah,
they see enhanced firm performance because they are inherently leaner and more forward-thinking.
exactly.
That ties directly into risk management.
Oh, heavily.
Green finance is proving to be one of the most sophisticated risk mitigation tools an executive can deploy. We tend to think of climate risk purely as a physical threat, but it is a multi-layered financial threat.
Right. You have the acute physical risks, a severe flood wiping out your primary distribution center or wildfire shutting down your supply chain.
Sure.
But the transition risks are often the silent killers of corporate value.
Transition risk.
Yeah, transition risk is the financial impact of the world moving away from your business model. It's the implementation of carbon pricing that suddenly makes your core product unprofitable to manufacture. Or it's the rapid shift in consumer preference that renders your legacy inventory entirely obsolete overnight.
So by proactively leveraging green bonds and sustainability-linked loans to decarbonize your operations now, you are essentially buying insurance against those catastrophic transition risks.
You are. You are future-proofing your revenue. And it has reached a scale where macroeconomic institutions are sounding the alarm.
Really?
Oh yeah, central banks, like the Magyar Nemzeti Bank in Hungary, are now actively integrating climate risk models into their national financial stability assessments.
Wow.
They recognize that a carbon-heavy corporate sector is a systemic risk to the entire economy.
So what does this all mean for the manager or executive trying to navigate this massive economic rewiring?
Well, the Green Catalyst offers a highly specific, actionable toolkit for them. It is structured as a practical playbook. It walks leaders through the process of building the foundational business case, demystifies the mechanics of financial instruments like sustainability-linked loans, and provides clear execution strategies for measuring impact.
The value of this playbook is that it teaches you how to quantify that greenium for your own CFO.
Exactly.
It shows you how to model precise carbon abatement costs, so you can walk into a boardroom and pitch a persuasive, numbers-backed business case that unlocks cheaper capital.
Yep.
And we are seeing massive, real-world applications of this toolkit right now.
Oh, everywhere.
You have companies like Air Products successfully raising $2.5 billion specifically for a clean hydrogen business.
Yeah.
You have major financial institutions like Intesa Sanpaolo
Right.
heavily prioritizing their green and social loan portfolios over traditional lending.
It's a complete shift. And really, the definitive takeaway of this entire shift in global capital can be summarized by a core argument from the text. The path forward is no longer a dichotomy between profitability and sustainability. Achieving lasting profitability inherently relies on maintaining sustainable performance.
Wow.
In the modern economy, you simply cannot have one without the other.
It is a complete paradigm shift from the old gym membership model we started with.
Absolutely.
But as we wrap up this deep dive, I want to leave our listener with a final thought to chew on. Something that builds on the very last section of the book's execution plan, which focuses on the future of this space. The playbook explicitly warns managers that they must accurately assess true financial returns and ruthlessly eliminate any form of greenwashing.
Yes, greenwashing is the next major hurdle.
Right.
Because as trillions of dollars flood into ESG-aligned investments,
Right.
and that greenium discount becomes highly coveted by every CFO on Earth, the temptation for corporations to fake their environmental metrics will be immense.
And that is the provocative reality we are heading toward. I mean, we started this conversation talking about the old myth, buying a gym membership just to say you go to the gym without ever actually doing the work.
Yeah.
Well, today, the gym is offering VIP interest rate discounts, millions in cheaper loans, and guaranteed B2B supply chain contracts strictly to the people who are in the best shape.
Right.
As those massive financial incentives take hold, how will you, in your own industry, differentiate between a company that is fundamentally rewiring its operations from the inside out and a company that is simply slapping a fresh coat of green paint on its decaying infrastructure just to chase cheaper capital?
That's the million-dollar question. And the market is building the tools to detect the difference between true operational resilience and a very expensive PR campaign.
Right.
And the penalties for being caught faking it will be devastating.
The era of the fake workout is definitely over. Take these frameworks, look incredibly closely at your own supply chains, and start doing the heavy lifting to build genuine resilience.
Fuck.
Thanks for joining us on this deep dive.